We know what assets are, and now we want to talk about a specific type of asset, which is a stock. So, what is a stock exactly? A stock is a small piece of ownership in a company. And typically, when you're investing in public companies, it's a very small sliver, but I'm going to give you a simple example here. And in our example, we're going to talk about Sarah. Sarah, she has an idea that she wants to start a company, and specifically, she wants to start a lemonade stand. However, in order to start her lemonade stand, she needs to purchase some resources. So she needs lemons, she needs pitchers, she needs cups, she needs spoons, and she also needs a lemonade cart that she can push around downtown. Now, Sarah, she does not have all of the resources that she needs in order to start this company. So she comes up with an idea, and she has a friend named John. Now, Sarah thinks John might be interested in helping her start this company, this lemonade stand. So she goes to him and she says, John, let's pool our resources together. I'll contribute some money, you'll contribute some money, and together we'll build a company and we'll each have ownership in that company. And as they work together, they pool their resources, they have enough, and they're able to form this small company, this lemonade stand. Now, in the example, Sarah and John both have ownership in the company. They're both considered stockholders. So whenever they make profit selling lemonade, they're going to split it between the two of them. And for this example, we'll say that each of them has a 50% ownership in the company. That means if they make $100 selling lemonade, they each get $50 of the profit. With this example, we need to talk about next how you make money owning stocks. And there's primarily two ways. The first way to make money owning stocks is through appreciation. So appreciation is simply the amount the stock increases in value. Let's look at our example of Sarah and John. At the beginning of starting their company, they just have one lemonade cart. And we'll say, for the sake of the example, that that cart is worth $100. However, as they continue to operate their business, they continue to grow. And eventually they purchase a second lemonade cart. So now they have two lemonade carts, and they also have some regular paying customers, right? They've built a relationship with people that come by every Saturday to buy lemonade. Their company is worth more now than it was when they first started out. They have more lemonade carts, and they have a loyal customer base. So their ownership in the company, if they were to sell it to someone else, would be worth more than what they had initially invested. That's the first way to make money owning a stock. Now let's talk about the second way to make money owning a stock, which is receiving dividends. And a dividend is profits paid to the owner of the stock. Let's go back to Sarah and John. Sarah and John have a successful Saturday, and they make profits of $100 selling lemonade that day. They decide that they'll save 50 of those dollars for buying new supplies, right? They need to buy more lemons. Maybe they need to replace some of their spoons and cups. And the other $50 that they made that day, they're actually going to keep as profits. So at the end of the day, Sarah counts up the money and she says, John, today's been a great day. Here's $25 for you, and I'm keeping $25 for me. That would be a dividend that they both receive. All right, we've looked at what a stock is. We've gone through a simple example. Now we're going to look at something different, which is a bond.